Apple's M1, M2 chips are the most impressive chips out there. The only problem is that Apple's platform isn't opened. If Apple were to buy Intel, that would probably be the best outcome. They're not going to buy Intel. I've read the
Psychology
books on
books you've
value investing
mentioned,
and
but
the
I still
psychology
don't
books you
fully
mentioned,
trust
but I still don't
myself.
fully trust myself.
With the Fed bond market
With the
carry trade
Fed
and
bond
tailwags the
market
dog, but seems
carry trade and tailwags the dog, though it seems it pushed the market back up after April, part one. Well, the carry didn't break apart in April. The April reaction was simply to the potential reorganization of supply chains, which then didn't come to be realized and then got delayed, and that allowed the market to rapidly recover what it had sold off.
Gorilla Mode put their pickle in my jar. I don't know what to prioritize or what is actually moving the market up so godly. As per Pickle's picks from late July till now, it seems like smart money is deleveraging but retail is not. Wouldn't that make the market go down? I thought retail wasn't big enough. Part 25.
The reason to buy them would be to get access to all of the federal funding. Ooh, 70 got burned. Interesting. Ding ding. I'm wondering what the second part of Gorilla Mode's Ko-Fi is here, because there's no question in part one. Is there like a limit to the number of characters? I don't know what to prioritize or what's actually moving the market up. So Godly is per Pickle's picks from late July until now. It seems like smart money is deleveraging, but retail is not. Wouldn't that make the market go down? I thought retail wasn't big enough. Retail's big enough with leverage. Did you look at the retail options volume? I mean, you can look at sectors that are underperforming. You can choose safe havens if you missed out on the run and you don't feel like participating in additional upside. It's retail's selling a lot of spreads, but they're not selling a lot of puts. Free $5 to go through free puts. I mean, the puts are only free if we open above 85. Well, above 80, I guess. I mean, it's pretty definitive that the majority of order flow over the last like 3 months, 4 months since the bottom in April has been largely retail buying. CTAs are not only underperforming the market, but they're still fairly neutrally positioned. Most systematic funds are still pretty neutrally positioned, even vol control. And then institutions have been net sellers pretty much the entire time, with the exception of like a couple squeezes on hedge funds. I'm very well aware of authorized participants. Yeah, they will do that. They'll make fake shares of everything. That's what they do. No, there's leveraged put selling that's outside of the scope of retail. But retail's definitely been on the call buying side. There's sectors that are underperforming. You can play sector rotation. I mean, you can try to target value in underperforming sectors. There's small caps, which are still fun. I don't think those are going to improve in performance. But I mean, if you're talking about like in terms of like long-term holdings, it's definitely a difficult market to find value in because everything's just kind of blown out. All right. Have you heard of synthetic shares? Yeah. The new rule puts the spot assets at risk. I mean, it did before, or at least helped drive volatility in the spot assets, which isn't necessarily bearish. But yeah, it creates artificial dilution. It's cyclical though, so I mean, if they artificially inflate the float for a period of time, that can only last for so long. This is like what went on with GME. You're describing something that they've been doing all along. They just used CNS and cash settlement to smooth it
Gorilla
over.
Mode, when
This macro view
investing,
is
when you
something I
use different calcs for
can't
different
fully grasp
industries, it
yet. When
seems like Wilshire
investing, when you
M2
use
is
different
best
calcs for
method to
different
value the market
industries,
per. Refresh
it
due to
seems like
QE
the
environment
Wilshire
5.
M2 is the best method. Yeah, generally speaking. JFresh due to QE environment. Yeah, if you're trying to get a look at the broader market, then yeah, I don't dislike that approach. It kind of ignores like global markets and stuff though. So I mean, you're still ignoring the effect of like currency pairs and all of that, which are fairly significant right now. But it can give you a good enough idea. I mean, you could make it even more simple and just use like the Buffett indicator. All right, I'll get started on the end of day. So closing pretty flat day over day, despite the extraordinarily hot PPI print. This is probably an anticipation for tomorrow's data, and also due to the just insane amount of leverage around like the 60-50 strike. Tomorrow's data pretty important. We have retail sales, we have import-export prices, manufacturing capacity, industrial production, and then at University of Michigan consumer sentiment after market open, all of which are probably going to be impactful for SPX. So the pre-market tomorrow could be kind of wild. So could after market open. Don't forget that all the delta from the AM contract will be falling off as well. University of Michigan's after market open. Out here on ES, we fell back to that local trend. We caught a bounce, but we slipped a little lower, right? Like we slipped below support a little bit before bouncing. That might have an effect here, given that we really didn't get a newer high, and we've yet to break back to the upside of that local trend. Obviously 64.74, a fairly important level here, and then a slip back to the downside below that. I would probably expect to set a new low locally, and then we'd be looking at this lower trend here for the next support, which would be down around well, maybe like right there, like 64.52-ish. That breaks down, opens a much larger move down to like 6400. To the upside, the only known resistance is 6502. Which I'm sure if tomorrow's data is bullish, we could definitely open at. Remember that going into the AM expiry, especially if the imbalance favors the bulls, can drive a lot of buying in the overnight session. So we might open higher, then sell off. Just because there's still a lot of sold puts up at 6,500 for tomorrow's expiry, and like some bot calls above spot. There are bot puts at 60.50 for tomorrow, but I don't know if those matter too much. Yields moved up today, obviously with the hot PPI print. We also saw a dollar move up about 40 points, moved up pretty strongly against the euro, and regained some of the ground it lost last night against the yen. Yields at the top end of the curve, definitely not back to where they were, but moving up, closer to 5%. The 10-year took a big move up, as did the 2. This is going to affect leverage a little bit with yields going up. That the gains in short-term leverage that we've seen over the last week or so, with Fed rate cuts getting priced in more heavily, this now puts pressure on that margin. On the correlation side of things today, we actually at the peak today came in still a little bit higher than yesterday's low, both on 3 and 1 month. And correlation continued to fall into close. So we might be getting a little breakdown in correlation here. I mean, that trend is a little bullish, but I would say that the moves aren't yet significant enough to really suss anything out from it. Like, it's definitely not a distinct breakdown in correlation. And we probably won't see a big breakdown in correlation until after NVIDIA earnings are passed. Because there's a continuous incentive to continue to trade the dispersion until after NVIDIA earnings are over. On the commodity side, oil up a bit today, 2.14%, so that's going to put upside pressure on inflation, but precious metals falling, agricultural kind of mixed, so is materials. Bond volatility is still dropping in line with that, although we might get a little bump in bond volatility from today's move in yields. Leverage on the carry trade right the back up again, and forward yield on volatility is still quite negative, 2.7% or negative 20.7%. A little bit of out of the money put demand yesterday. I don't really know if that survived today's bounce. Stocks above their 50 and 20-day moving average continuing to push up, and this does have a little bit of breadth on it, but still very narrow between the top performers. Today is the first gain in correlation between VIX and cash VIX for the last 9 days, 9 trading days. It's only 0.02 change, but interesting that short vol wasn't further levered up today, and I would say overall net fell. Fed fund futures obviously pulled back to about where we started the month before the Fed rate cuts started getting priced in. So we've got zero point 0.4 in cuts priced for January, so a little bit back below where we were getting very close to 2 rate cuts by the end of the year. March of next year down to 0.64, and June of next year down to 0.855. So no longer really pushing for the 4 cuts by middle of next year with the inflation data, but we will probably need another round of inflation data to really defeat those presumed cuts. Bear steepener dropped a little. Out here, I mean, still bullish on the daily, slightly. We did not get yesterday's high, but we haven't broken down like below like the 64.27 level that would mark any kind of actual rejection. And then, you know, even that probably wouldn't be confirmed unless we fell back below 6,400. At which point, yeah, then we could start to move for like a test of the EMA 30, and we could confirm more downside continuation. But right now, I mean, this is still just bullish consolidation on top of the breakout. So technicals still look pretty good. We obviously have the back half of March and the end of this week to determine if the next 2 weeks are going to be a little different from the prior. Seasonally, this is starting to get into a period of time where we generally see a lot of profit taking, but I would say that's a kind of useless metric. Yeah, so that's about it for that. You got something else, Scroll? Seems there's a lot you have to investigate to spot shit before it hits markets hard, so you can capitalize on it. I can go fully autistic learning this shit. I just don't know what to focus on. Should I just try to master GS and forget macro? End of day was how you felt your first years. I mean, it depends on what you want, right? Like if you want to just trade and make money, then I would say it's probably better to learn options pricing and learn how to utilize Gamma Strike. If you wanna learn all about the macro environment and try to capitalize on big structural changes in global economics, then I mean, yeah, read all the books. Did you read Fisher Black? Fisher Black's a good one. You could read some of Ray Dalio's papers, not any of his books. Those are useless. Some of his papers are fairly insightful on the, US-China relations, things like that. But those can be like very, very long-term plays, and they're usually extremely capital intensive. So I would say unless there's some reason for you to need to be an analyst or you're trying to make a career out of that or something, then probably just focus on the trading aspect, which is far simpler. But you can DM me, man. Just hit me up in the DMs, and I can recommend you some other stuff, or you can discuss more at length what you want to know. Don't forget, end of tonight we have the Gamma Strike Roundtable, so we're gonna be covering that 9:15. I have it scheduled for, so right around there. I'll probably be starting it. Anyway, thank you guys so much. I'll catch you later. Peace.